Hi guys, thanks for tuning in to another episode of Nuggets News. Today, welcome a really special guest, someone that I've been wanting to have on the channel for a long time, and that is Brent Johnson, who's the creator of the US dollar milkshake theory. So we're going to be talking all about money printing, inflation versus deflation, and I'm really looking forward to sharing my theory about how the stable coins are going to play a big role in all of this. So I guess welcome to the channel, Brent, and maybe just to give everyone a bit of a background and how you came about to think of this milkshake theory.
Sure. Well, first of all, thanks for having me. I'm excited to be here. I always like to talk about this stuff. It's an interesting time because you've got I keep using the word the singularity because you've got all these different fields that are kind of crashing together, economics, politics, finance, digital coins, fiat currency, hard currency. So to me, it's just an extremely interesting time right now. But I have a firm called Santiago Capital in San Francisco. I'm a registered investment advisor where we manage money for a number of high net worth individuals. And I also manage a private fund, which is focused on kind of the currency markets and stuff. I guess to your point, how did I get into this business and how did I get here? I started off with a large Wall Street firm back in the late 90s. I was with Credit Suisse for a number of years. And that's kind of where I learned kind of how Wall Street works, quote unquote. And I had kind of a fortuitous meeting in 2007, which caused me to kind of start investigating the monetary system and how it actually worked. And it was kind of a blessing and a curse because I went to my bosses and I asked them the answers to these questions that had come up in this meeting, and they didn't know the answers, and they didn't think the answers were important. But I thought they seemed like pretty simple answers, and the fact that they couldn't answer them and the fact that they didn't think they were important made me kind of question their expertise, so to speak. And so I started doing the investigations of my own, and that kind of led me to a couple eye-opening conclusions, for lack of a better word.
Yeah.
And that set me on. And because I couldn't go to my bosses or my superiors or my colleagues for the answers, I started on a period of self-discovery, for lack of a better word, self-education. I started looking at the origins of currencies and the origins of money and how it gets into the system and how it moves around the system and what are the other theories. So I found Austrian economics and then so that kind of I'd always kind of had an interest in gold and silver since I was a little kid because my dad used to collect some gold and silver. And I think there's something inherently interesting about gold. I think it's in kind of all of us. When you really get down to it, when you hold a piece of gold in your hand, it just feels different than everything else.
Yeah.
And so that kind of appealed to me a little bit. And anyway, that was the beginning of it. And I guess I would say the last 10 to 12 years have been preparing me for the next 2 to 3 years because I think it's all kind of coming to a head, for lack of a better word. And I do think that this stuff always takes longer to play out than people think it will. So I don't think this is all going to happen over the next couple of weeks. I think it'll actually take another 2, 3, maybe 4 or 5 years.
Yeah.
But I do think I do think we're in the early innings. I think the game has started, so to speak. I don't think it's way off in the future.
Yeah.
And so that whole process led to the dollar milkshake theory. And the dollar milkshake theory essentially is one of, I am of the belief that even though the United States dollar is a horrible currency, it's better than all of the other fiat currencies because all fiat currency has problems.
Yeah.
And so if you're going to throw stones at the dollar, that's fine. I completely understand it. But then you also have to throw stones at the Australian dollar and the British pound and the Japanese yen and the Chinese yuan because they all have these negative side effects. And when you realize that they trade relative to each other, one of them is going to win the battle.
Yeah.
And I am of the belief that for several reasons, the US dollar is going to win the battle of the fiat currencies.
Yeah.
Now, that doesn't mean that gold isn't going to go through the roof. I think gold's going to at least $5,000, probably higher. But I don't think it will be in a straight line. And I think while gold is ascending, I think the US dollar, for lack of a better analogy, is going to go around the world and cut off the heads of all the other fiat currencies. And I can go into the reasons why that is.
Yeah.
But that's the dollar milkshake theory is the theory of sucking up the capital from around the world into the US dollar and into the US markets.
Yeah.
It came from a movie several years ago called There Will Be Blood about a evil oil baron who was going to suck all the oil up from his neighbor's land and kind of cash in on that oil. That's the genesis of it.
Fantastic. Yeah, we have covered this a fair bit on the channel as well, so people hopefully are fairly familiar, but we do have beginners as well, so we'll try and explain things in easy to understand terms. You've already touched on so much that I love, and we've got a saying, I'm not sure if this is just an Australian saying, but the cleanest dirty shirt in the laundry, the US dollar, which we definitely have been talking about. In terms of gold being special and unique, I also think that, getting a little bit philosophical early on in the interview, that, you know, gold's all through the universe and it only comes from these supernova explosions and gets scattered throughout. So it is inherently rare throughout the entire universe, which I think makes it a little bit special as well, as you say, when you hold something like gold or silver. So, yeah, I mean, where to next? Let's maybe get into what is happening at the moment, because there's a lot of this dollar printing, and a lot of people thought back when QE first started that it was going to end in inflation, and that's when gold and silver went on a bit of a run. And as you say, these things take time, because they had their run and then they settled down as everyone thought that world was going to normalize and have high interest rates, this, that, and the other. And a lot of people could see that this was coming one day, but markets are so short-term focused, and yet here we are at this point, which a lot of people almost thought was a given for many, many years. So once again, we're in this situation where there's a lot of dollars being printed. People aren't as worried about inflation now as they were back initially, because gold and silver took off, and now people are sort of saying, well, we haven't seen inflation for 10 years, we're never going to see it. And central banks are even sort of welcoming it and saying we might let the economy run a bit hot. So what are your thoughts about where we are now, and maybe why it's possibly different this time, or is it the same, we're just not going to have inflation for 10 years?
No, well, I wouldn't say that we're not going to have inflation for 10 years. I would say that the primary driver right now is deflation. And I should also clarify, when I answer these questions, and when people hear these questions asked and answered, you always have to consider which currency you're in and where you're sitting. In other words, the answer for an American might be completely different for someone in South Africa or Australia or China.
Yes.
Because if one currency is falling, another currency is going up, and that will have different effects on you. So I guess my point is keep that in mind. I think the debts in the world are the primary driver, and debt is deflationary. And when debts get defaulted on, it isn't just the demand that crashes, it's the supply of currency crashes. And as that supply of currency crashes, there's less currency to go around. That's deflationary. Now, the central banks are trying to offset this, right? And they're trying to plug that hole. In my opinion, they are not even close to plugging that hole yet. And part of the reason they're not plugging the hole yet is the velocity of money continues to fall. Now, when you really get the big inflation, or at least the inflation that everybody worries about, runaway inflation or hyperinflation, you have to have not just supply of currency, but you have to have velocity of money. They can print $10,000 trillion, but if it just sits in a vault and doesn't move, it's not inflationary, right? The problem comes when they've printed all this currency in order to plug that hole, in order to combat deflation. And then all of a sudden you get the velocity. Now you've got the velocity and the supply, and then it gets away from them to the upside. And I think that will eventually happen, but I just don't think that we're there yet. So I would come down on the deflation side, to at least for now. Yeah,
and that comes with a lot of the other, I think it's the 3Ds or 4Ds now that people are talking about, with the demographics, with older people, retiring and downsizing. And I think something that's only getting spoken about a little bit more now is the accumulated wealth or value of a lot of these assets, and the value on the screen is very different to maybe in crypto. We've got this saying, the realized market cap, because a lot of these small coins have got a high perceived market cap because you just multiply the last price by the supply. Sure. I think there's actually a similar thing happening in the stock market world. And a lot of people have had some of these shares or their property, their house on their street, in their portfolio for 30 years. And then one house on the street sells for $1 million. But that doesn't mean that all 50 houses on that street would be able to be sold for that price if you tried to sell it. And I think that is what, as you're saying, they're trying to patch these little holes here and there. Now it's the junk ETF bond market and the repo market. But in reality, if we get to a point where there's a lot of people trying to sell all these assets, I just don't think there's anywhere near enough buyers, and the actual value is a lot lower than what they're saying. So what do you think about all that? Is that something that's not spoken about enough?
Well, no, I mean that's true, and I guess that's true whether you're in a bear market or a bull market or in inflation or deflation. If the listen, whether you like it or whether you hate it, the matter of fact is that we live in a fractional reserve banking world.
Yes.
That it's just the way it is. Money is loaned into existence, and as a result, if everybody shows up at the bank on the same day to get their money, the bank goes bankrupt because they don't have enough reserves to give everybody their money back. They've loaned it out, right?
And does that maybe changed a little bit with, is it Neil Kashkari coming out and saying we're going to print infinite amount of money, so if everyone wants to come in and withdraw, so the Fed are also trying to fight that now?
Yeah, exactly. But to the point is, like, March was a perfect example of everybody wanting to sell at the same time, and the markets just got liquidated. There was no decision made. And listen, I'm perfectly happy to agree with somebody who says the markets were very overvalued and they needed a correction. That doesn't change the fact that there was no valuation decisions being made when people were selling. They did not care what price. They just wanted cash, and they would specifically U.S. dollar cash.
Yeah.
And you know that because they sold everything. They sold gold, which sells in dollars. They sold treasuries, which is in dollars. They sold stocks, which is in dollars. And so, I mean, other countries, markets went down as well, but I think that this is a run on the U.S. dollar. There's just not enough dollars to go around. And the example that for people who maybe don't quite understand what I'm talking about, but who are familiar with the gold and silver markets and the way they trade, a lot of times, you've heard about the COMEX is where, futures for gold are sold, not really physical gold. And the volume of futures contracts is like 200 times the actual physical gold that's underlying it. Yeah. Well, I can tell you the exact same dynamics occur in the dollar market. There's only 6 trillion of the monetary base, which is actual physical currency and the reserves at the Fed. All the other money in the world is loaned into existence. And I'll tell you that ratio is dramatically higher than 200 to 1.
Yes.
So if you believe in this, musical chairs 200 to 1, everybody standing for delivery on the COMEX, and that's going to push the gold price higher. Well, that's exactly what was happening in February. Everybody was standing for delivery on their dollars. They wanted the physical dollars. They were calling in the loans, so to speak. And people just had to get liquid in order to provide them. And that was pushing the dollar price higher. And the dollar price going higher was creating a knock-on effect of more people having to sell. And so that's kind of the heart of my dollar milkshake is I think whether you like it or not, the dollar is the world reserve currency. Whether you want to leave the dollar or not, the fact is you have to pay off the dollar loans or you're going to default.
Yes.
If you default and say, I no longer want to deal with it, that's fine. But then the supply of money contracts even more.
Yeah.
And those who still do need dollars have to get it at a higher price. So this is the milkshake. This is the squeeze of the system, squeezing all the liquidity into the dollar.
Yeah.
And until there's a new place for them to go to, maybe it's gold, maybe it's Ethereum, maybe it's Bitcoin, but until the whole world decides what that is, it is the dollar.
And to give people a couple more examples from the real world, to emphasize this theory of a straw being in the US, every time the Fed are printing dollars, now they've actually opened up those swap lines directly to try and, I guess, bypass that straw theory of the sucking out of the US. Yeah. But what Brent is saying is it's different again to even getting physical delivery of the gold on a contract. It's not physical delivery of US dollars. People aren't trying to pull out $100 bills. It's just the fact that they're going out of all these derivatives that are all priced in US dollars into a digital form of US dollars, and there's not enough even in the digital form. This is why what's his name comes out, Powell at 60 Minutes, saying that we're digitally printing all this because there's so many people. And in Australia, when we crashed to 55 cents that day, the Nuggets News support team were getting hundreds of messages. How do I get out of the Aussie dollar? And it was actually a capitulation. And even that, guys, you think of it as selling your Aussie dollars, but it's buying US dollars. And those banks, they've got to get them from somewhere. So this is all happening in the real world in different shapes.
Exactly. No, that's a perfect example. And you've seen, and that was a panic, right? It went from 65 to basically 55. And now that the panic has subsided, it's back up to about 65. Now, I'll tell you, I think that's going to happen again, and I think it's going to happen to an even greater extent. But for the short term, the firemen came in, they threw a bunch of water they provided a bunch of liquidity, they put out the fire, and we're back to business as usual. but nothing has been solved.
No.
The same problem that existed before March in the Aussie dollar exists now. The same problem that existed in euros still exists. The same problem that existed in US dollars still exists.
Yeah. So I did a video that day saying something along those lines, Brent, that putting on a trader hat, this is a capitulation, guys, and we're probably going to get a bounce here. But you're saying that you do think over time a lot of countries, and is this an emerging market, net exporters? That's the next topic I want to dive into.
Yes.
Is that the same situation where the currency is probably just going to grind lower over time until something changes?
I think so, because I don't think there's huge demand for commodities right now. Now, you might believe that you might think that your standard of living is going, the cost of living is going higher, and you may think that your healthcare costs more, and so from that perspective, perhaps you're seeing some, cost of living inflation. But there's not, with the economy, global economy slowing down, there's not an increased demand for lumber. There's not an increased demand for steel. There's not an increased demand for copper, especially with COVID now. So the industrial commodities, I think, will continue to fall.
Yeah.
And as those continue to fall, then that means those commodity exporting countries' top line revenue comes down. Now, the problem is they still owe US dollars that they've borrowed over the last 10 years. And some of the other input costs perhaps are going up. Labor costs perhaps are going up, or whatever it is. So you can get into a situation where, or their imports prices are going up. And so you get into a situation when your top line has come down, your bottom line is rising, or your bottom line costs are rising, and you just get squeezed. And, the reality is that countries, if they're going to operate on the international stage, need dollars to do it. If you're dealing in commodities, it happens in dollars. If you're trading, if Brazil is trading with Spain, it probably happens in dollars, or predominantly happens in dollars. Now, there are some bilateral trade agreements and there are one-off things, but in general, most of global trade takes place in US dollars. And so that demand for dollars is still there to service the debt. If you don't service the debt, then you become uncreditworthy. Argentina is a perfect example. Let's pretend that you run a business in Australia and you do business with those in Argentina, and they have now defaulted on the debt. And now they start over. And they come to you and they say, let's say you sell lumber. You say, I want to buy some lumber. And you say, okay, but you're going to pay Aussie dollars. You're not going to pay, or you're going to pay US dollars. You're not paying us in Argentinian pesos, right? So there's no demand for Argentinian pesos. So that means the price of the Argentinian peso falls. And then they have to print more pesos to go out and buy dollars, so then they can buy your lumber. And if they're printing their pesos and they're buying dollar, that means that the dollar goes higher and the peso goes lower. That's how you get inflation. Yeah. That's how you get hyperinflation, when you have a currency that there's no demand outside your own country, and you have to print it to operate on the international stage. That's why I say the dollar will be the last to fall, because outside the United States, there's great demand for dollars. But outside of Australia, there's not great demand for Australian dollars. Outside of Bangladesh, there's or Thailand, there's not great demand for the Thai baht.
Yeah. I was going to say, there's a fantastic chart that we often use, and it shows the number of currencies around the world. And there are, I think it's a few dozen at least, that are in the hundreds of billions or more market cap. And they really just are these nothing Southeast Asian currencies that are going to continue to grind lower. Is there a counter argument here, or how does a country avoid this situation? You need to have a very robust economy and export goods, semiconductors, or things to the world that are really in demand. Is that the only way to avoid this?
I think so. I think like Germany's a great example. The problem is Germany's part of the euro, but if they had just the German mark, I think the German mark would be incredibly strong. Yeah, because they have great industry. They're in a pretty good fiscal situation. They've got great trading power. So I would feel comfortable owning the Deutsche Mark. Yes. But because it's part of a federal currency, I don't want to have anything to do with the euro, right? The other thing that you can do, and you've seen a lot of countries do this, is they buy gold, right? They either maintain dollar reserves or they buy gold, because that will help, but it doesn't actually solve the problem. Again, they've taken on all this debt, and mostly in dollars. And because you can't print the dollar, the Fed is the only one that can print the dollar. And so the only way that they can get out of this debt trap is to earn more dollars. And so if the global economy picks up, and in this, this country, that their economy starts to expand, and they use the profits from their exports to pay down their dollar debt, maybe perhaps that's a way to get out of it. But I just don't think the economic growth engine is big enough to do this.
I heard a really interesting one the other day, because like China are trying to position themselves in a similar way in, say, some African countries. I was telling people that my mum does a bit of work in Tanzania, and they recently defaulted on, I think it was a $10 billion Chinese loan. So China are trying to get in there and make the yuan, stronger and in the same situation. But what are the risks for people that default on either the yuan, and there's those other political ramifications, but why don't countries, or explain to people at home why countries can't just default on the US dollar, because you can't just sort of start fresh and say, well, now do business with me again, can you?
Well, I guess, and that's the point I was trying to make with the Argentina and Australia example, but let's use it with the US and some other country. Let's say Indonesia defaults on dollar loan. Now, they actually have a swap line, but let's pretend they didn't, and they started to default on dollar loans. Well, now they defaulted on their dollar loans, but now they've got, the only thing they have is ringgit, right? Well, who wants to transact in it with a company in ringgit from a country that just defaulted? Yeah. Nobody. Or if you do, you're going to demand a much higher interest rate. So they would effectively be a junk bond, right? They'd be issuing junk bonds. So, if they just default, now they are sitting there with no dollars, and they're sitting there with with a currency that nobody outside of Indonesia wants. And so you either have to pay up an exorbitant price to use those ringgit, or you need to borrow in dollars. Right, but then you're right back where you started. And let's say you do, you're just not going to use the dollar, and you're going to pay that higher price to raise money in ringgit. Well, that's fine, but you've still got to. Now you want to trade with the United States. We don't want ringgit. You've got more ringgit now, but we don't want to. We don't want to trade in that. We're not going to send you goods for ringgit. So you've just locked yourself out of the biggest economy in the world, or the biggest consumer economy in the world.
Yeah. I think one thing that is a message I just continue to drive home for people is how money has just become so much more than a way just to exchange value from one person to another. Yeah. It really has become so political. And what you're describing there with the fencing yourself off from the rest of the world is what we're seeing, where we sort of hit peak globalization, and now we're already seeing someone like Trump start to bring jobs back to America. But it's that process of, well, maybe Indonesia need to become more, strong and self-reliant and all those words because of what's happening with the dollar and that financial system. Whereas if they didn't, if there was some neutral currency, or the US dollar didn't have that strength, it would possibly be different for world trade. Yeah.
Yeah, absolutely. And I think, had the world come to this realization 10 years ago or 12 years ago, because there's always this desire to leave the dollar. I will acknowledge that right now. I think the whole world would love to leave the dollar system. There's a difference between wanting to do something and the ability to do it. I would love to be, Phil Mickelson on the golf course. That doesn't mean I get to, So executing and knowing what to do and actually executing it are two completely different things. And it's just not possible, I don't think, to until the whole world agrees on a new system. We're stuck with the system that we have. Yeah. And it's just much harder to do than many people think. And going back to the defaulting option that we just talked about, I hear people all the time say, just walk away from the debt, just default. They'll just default. Well, going back to your question a minute ago, it doesn't work that way. And I can use a really good example to show you why. I would guess that just about everybody who has bought a house in the last 6 months to a year in Australia is probably underwater. Maybe not, but they probably hasn't gone up a lot, but maybe it hasn't crashed. But in March, I think a lot of people that bought a house 3 months prior would be happy to get out. Mm-hmm. But you don't just default on the house and walk away. And why don't you? Well, because then you have bankruptcy on your
Well,
record.
in Australia, you carry the debt, actually.
Well, you carry the debt,
Yeah.
right? And so it's impossible just to completely walk away. There are consequences to just walking away. It's not like you just get to walk away and there's no consequences. In the same way that as individuals, you don't just get to walk away with no consequences. As a country, you don't just get to walk away with no consequences. Now, I will say the bigger and stronger you are, the easier it is for you to default and walk away. But even then, it's not completely possible to do.
Yeah.
I would say that the U.S. gets away with a lot more shadiness than anybody else.
Yeah.
But it's because we're the biggest boy on the block, and I don't necessarily like it, but it's true.
Yeah, and to expand on that point, we've got probably only the Chinese and Russia that have that ability to be the big boys that stand up because of the size of their economy and because of Marin Katusa's book behind me, The Cold War, where Russia have so many assets and the assets that they don't have, they've also got the ability to process a lot of uranium, but that's a different story. But they've got a lot of resource power coming forward where I think energy is going to have a lot of impact on the world. And that's where we get into this whole shale oil debate. If we can get rid of the US being oil dependent, that puts more pressure on them as well. Anything to add to all of that?
No, I think that's 100% right. I mean, the shale oil revolution, or however you want to call it, has allowed the U.S. to become somewhat energy independent. Now, depending on how you measure it, some people say we still import, but on a net basis, we don't import. But by and large, this shale revolution has allowed us to, on a net basis, import less oil. And you could even argue that we're now exporting oil on a net basis. Yeah. And so that's important for a couple reasons, because the debt because the dollar is the world reserve currency, all this US dollar debt has built up over the last, call it 50 years, dramatically in the last 10 years, but over a 50-year period. And that was always not too much of a problem because we exported a lot of dollars to the rest of the world. And one of the main ways we exported dollars to the other world was we imported oil. So they sent us the oil, we sent them the dollars. They borrowed in dollars because we were paying them in dollars, and they could finance at a lower rate in dollars. They earned their revenue in dollars. They could service that debt in dollars. Well, now they still have the same high level of debt, but we're sending less dollars because we're not only are we importing less oil. The oil that we are importing is done at about a 60 or 70% discount to the price that we used to do it at.
Yeah. So
they still have this high level of debt. They're getting less imports of dollars, and the value of the imports are down 60%. So you've got into this situation. It's like if you bought you had a great job, you bought $1 million house, and then you lost your job and you had to go work for half the pay that you were working for before. You still have the mortgage of the $1 million house, but now your income's been cut in half. Makes it pretty tough.
What percentage of the dollars getting out to the rest of the world every year was coming from the oil?
That's a good. I actually don't have that number. I should look that number up.
Okay, yeah, that would.
But it used to be significant, and it's much lower now.
Okay,
but I should look that up. That's a good question.
Cool. Something that I was been tweeting about the other day was the fact that we've got Powell on 60 Minutes saying that the government need to do more. It's sort of fiscal policy now. We're out of tools. We're at 0%, and then you've got Trump saying a few months ago we need to go to zero, and he got his way, and now he's saying negative interest rates, print more money. So it's a similar situation in Australia where we've got our head of the central bank, Philip Lowe, saying that the government need to do more, and the government are trying to get this surplus, and saying that the RBA need to do more. So people at home, I really want them to understand the fact that it doesn't really matter these days who presses the button on the printer anymore. The US have had this $3 trillion fiscal spend, and then the Fed have printed trillions of dollars as well to buy these bonds. So whoever's in charge of money and the battle for money is kind of changing, because the banks can create money through those loans, and some people don't agree with that. But you've basically got banks, central banks, and governments that are also saying, well, we have the ability to create money to some degree, and they all want to feel important. But now it's like, well, who has the power to do that? And this is where we get into modern monetary theory. So what are your thoughts on all of that?
Well, I think it's ridiculous, but I think it's going to happen anyway. I mean, I think we're too far down that road. Everybody knows that the central banks they're not out of power, but they've used up a lot of their tools. And it's the same all over the world. And, all these guys talk to each other. They're all colleagues to a certain extent. And once one of them does it, they're all going to do it. And so I think you're going to see an extremely large fiscal push by the U.S., and I think everybody else will follow. And I think you're going to see, and you're already starting to see, even though first of all, I want to dispel a myth. This myth that central banks are independent, I don't buy it. Maybe they try to be independent, and maybe they are given a mandate to be independent of political influence, but that's when things are going well. In a crisis, you're going to see that independence yanked.
Oh yeah.
Because at the end of the day, the central banks are regulated by the Congress or by the governments. So I think you're going to continue, and as we kind of hit to the end of this crisis or into this crisis, they're going to be looking for new tools with which to fight deflation, and you're going to see a closer coordination between countries' treasuries and countries' central banks. And it'll be in the U.S., it'll be in Europe, it'll be in Australia, it'll be in Japan's already kind of doing it to a certain extent. So I think that is definitely going to happen. I think that you'll see a huge fiscal spend in the United States. And I think, this is where I get into an argument with a lot of dollar bears who will say the rest of the world is no longer going to buy our treasuries. Well, I say maybe not. I think that they will still come back. I think they would rather own a U.S. treasury than a Japanese treasury or whatever it is. But even if not, I think that for a number of reasons, the Fed can buy a lot of the U.S. issuance. And people say, well, that will cause people to lose faith in the dollar. Well, that's fine, because people are going to be losing faith in the euro and the yen. Again, it's all relative. I don't, and because we have so many other advantages, the deepest capitalist markets, the rule of law, the U.S. Navy, the dollar payment system, all of these reasons that give us an advantage over other countries. Again, whether we deserve it or not, that's not the question. The fact is we have it.
Yeah.
And so I think that's going to happen. The other thing that I would say is that all of this money that's going to get spent by the governments and all this QE that's going to be done by the various central banks, I don't think it's so important who does the printing as who captures it.
Yeah.
And I've said this before, and this kind of goes to the dollar milkshake theory as well. I think all of this currency is going to get printed around the world, but I think it's going to very quickly get converted into US dollars. Because I think we will be the most attractive place on a relative basis. And so even if all the printing comes out of the Japan, I think they'll sell the yen and buy the dollar. The printing that takes place in Europe, they'll sell the euro and buy the dollar.
Yeah.
I think that's going to happen. People disagree with me, but that's what I think is going to happen.
I agree. And it goes back to what you said at the very start about when you ask your bosses and your colleagues, and when I talk to even economists, or when economists say 18 months ago, we're going to raise interest rates in Australia, I just don't see how these people cannot understand what is going on around them, because they're just so obsessed with these models. But what's happening in the real world is just very, very different. Now, I think that Powell got behind the curve to some degree because he wanted to be independent when he got first, not elected, put into power, but he had to do the backflip from raising to cutting, and then he kind of had to give in to Trump and got his way. But what I think was very interesting that happened a few months ago, and then this week, we had Mark Carney, Bank of England, come out and say US dollar has too many privileges. We need to go to possibly a digital system, or we'll get into the crypto side of things shortly. But then this week we had them come out and say that we're looking seriously at negative interest rates. And it was only a few months ago when they were all saying that they're off the table. And Philip Lowe, head of the RBA in Australia, said that these are actually damaging. The evidence now suggests that they're bad for banks, they're bad for confidence, and they haven't really worked that well. So it's just to me, the fact that we've got the two of the most important central bankers saying things that are at odds with each other, and they're out of tools. When I sort of tweet and joke that they've got no idea and they're making this up as they go, you just said it yourself. They're going to have to try and figure out new ways to do things, because it's true.
I mean, at the end of the day, I did a presentation on this several years ago where I kind of compared, central bankers to magicians. And the reality is they have a million different ways to do the same trick, right? The trick is that when money gets loaned into existence, you have to have a certain level of velocity so that money that gets loaned into existence, the interest gets paid, right? And when that money velocity stops due to, slow economic growth, or the debts get too big, or COVID, for whatever reason, when that money stops circulating, the debts start going bad. And the trick is that the Fed has to come in and create money by recapitalizing the system. And they do this by, in some form or another, extension of credit and lowering of interest rates.
Yeah.
And so they have all these different names for it. They call it different programs, and they say it'll be for different durations. But essentially, they're just creating collateral out of nothing. And so the problem never gets solved. It just gets kicked down the road, and it gets bigger. And everything that's happened in the last 2 months, I promise you, nothing has been solved in the last 2 months. Absolutely nothing. The prices have gone back up. They've started to recollateralize the system, and that's allowed velocity to pick up a little bit, but they have fixed absolutely nothing.
So the thing that I did want to get back to, your point that I really like, was back when QE started to get tapered and people were saying, oh, the markets are still going up, see, it's great. People weren't acknowledging what you were saying, that the ECB was still printing, I think it was the equivalent of whatever, 30 or 40 billion a month. And Japan and all that money was making its way into the US, particularly the stock market and treasuries, because that was the best place to invest. So it doesn't really matter that the Fed are tapering. So when we have these central banks that can print money out of thin air, it's the Swiss National Bank the other day, they come in and buy some shares. It's all the same, isn't it? It's all just getting out of their currency into the US somehow.
Yeah, and it's funny because several years ago when the Swiss National Bank started buying U.S. equities, I mean, it's quite a while ago now. It's like 4 or 5 years ago. I thought, God, this is just so ridiculous. Now they're buying equities. And I thought, what are these morons doing? But the more I thought about it, it might be better to buy a share of Coca-Cola than to buy a government bond that's going to become worthless. Right? So if the Swiss National Bank has the ability to print currency out of nothing and buy shares or buy a piece of a company that's worth something, it's probably not a bad arbitrage. Whereas, the US is buying bonds that will be inflated away. The European Central Bank is buying bonds that'll be inflated away. Japan's buying bonds that'll be inflated away. Maybe the Swiss have something right after all. I don't know.
And do the rest of the world take I guess, almost an opposite stance and say, well, why are we giving all our gold or uranium, oil, resources, whatever it is, to this country that's just printing money out of thin air? And does that happen between the different countries? They say, well, hold on, these guys are just printing out of thin air. Why are we giving them our resources?
Right. Yeah. No, I mean, I think again, we get back to the singularity. It's all coming to a head. And I think the issue I see is, I think there's great desire to come up with a new system. There's great desire to leave the dollar. There's great understanding that this is just not going to work, and there's going to have to be some kind of a reset. The problem is coming up with something that everybody agrees on. If you've ever been in a meeting with more than 3 people and you tried to get even 3 or 4 people to agree, it's not easy to do. Now you get the whole world to agree. And whatever new system comes up, there's going to be winners and losers in that new system. But to get everybody to agree that it's a win-win for everybody, and then you figure out who's going to design it, who's going to maintain it, who's going to enforce it. It's not a simple answer. And people won't agree to it until it's a crisis. When it's a dire crisis, you can get people to do things they wouldn't otherwise do. But so what they do right now is that they just kick the can down the road. And so I think the crisis now is within a couple of years, 2 to 3 years. And I think that will force the hand of coming up with a new system, or devaluing all these debts, or writing them off. I don't know what form it's going to take, but something greater than has been so far is going to have to be done.
Yeah. And I don't want to get into the crypto stuff just yet. I've got 1 or 2 more points, but everything you've just described just there is what I was saying to you in the pre-interview, where you've just described the investing thesis for Bitcoin. It's political, it's neutral, it doesn't favor anyone more than others, and that's where I just think as soon as that first country starts to maybe buy it along with their gold reserves to try and shield a little bit, then that can all happen very quickly. But we'll get into that in just a second. What I wanted to talk about was the paper the Chicago Fed board put out talking about fiscal and monetary policy going hand in hand. I'm not sure if you saw this, but they're talking about controlled inflation to erode debts and how it was going to be temporary. And it reminded me of this whole 0% and QE is going to be temporary. So, hey, what do you think about that? And I guess the way I think about it is no matter what they do, it's kind of always resulting in more inequality because of the way the system works. So if they try to suck money out, if we get inflation, and they raise taxes or try and pull money out, it's always coming from that lower 90% because the wealthy guys have got it in their trusts or they've already got their property. Or do you agree with all that? That's kind of the problem that they're facing with putting money in or putting money out. It's always resulting in actually more inequality.
Yeah, I mean, and so I think that's kind of coming to a head too. And so this is going to get a little confusing, but hopefully I'm able to explain it in a method that understands. The fact of the matter is that the solution that central banks have always come up with till now is, as I said, they do different versions of the same trick. But the same trick, while it does recapitalize the system, it rewards the rich at the expense of the poor. And so you get this incremental, inequality. Boom, 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 boom. And you've seen that just expand over the last 2 or 3 years in spades. And that is partly what's leading to all these populist uprisings around the world. The people at the bottom are starting to say, this is bullshit, right? For lack of a better word.
Yeah.
And so when somebody comes along and says, we're going to change this, we're going to bring the resources back and we're going to pay you a higher wage. And, that feels good. You innately understand that, somebody's trying to change something and they're thinking about me rather than thinking about those at the top. And so you can kind of understand why those populist movements gain strength. And so now this is where it gets a little confusing. And so my point is as all these countries around the world cave to these, deflationary pressures and print more money and do more fiscal spend, if I'm right, and that money comes flowing into the United States and it pushes up U.S. asset prices, whether it's the stock market or whether it's real estate or whether it's whatever it is, the bond market, we're able to finance our treasury better than anybody else. It becomes increasingly hard, especially if the stock market goes up, but cost of living goes up, and you get this, again, the expansion of the inequality. And Main Street is suffering because we have high unemployment now because of this COVID, but yet stock markets are back at their all-time high.
Yes,
you're going to start to see populist movement in the United States as well. You already saw it with Trump.
Yeah.
The kindling is already there for this. Once that happens, it will become increasingly hard for the Federal Reserve to bail out the rest of the world. So you mentioned these swap lines. We're bailing out the rest of the world, or we're providing the rest of the world with stimulus or dollar liquidity through these swap lines. Well, it won't take too long for some clever politician to come along and say, why is the Federal Reserve bailing out Norway when Newark has unemployment? Why are we giving a swap line to Brazil when Birmingham, Alabama has cost of living going through the roof? Why don't we bail them out rather than Brazil? And so I think the more that you get that inequality happening in the US, the harder it is for the Federal Reserve to bail out the rest of the world. And I don't think they'll be able to do it to the extent that many people think that they will. And when that happens, it exacerbates the dollar shortage. It exacerbates the ability for these other countries to pay their dollar debts. It pushes the dollar higher, and so it's all self-reinforcing to a certain extent. Now, listen, first thing I'll say, I'm not going to get this all right. I'm sure there are several parts of my theory that are wrong. But if it happens like this even a little bit, I think it has incredible consequences for global markets.
Yeah.
And I don't have to get everything right for this to be an incredible negative for global markets, but there's also opportunities that go along with it. So anyway, that's I kind of went off on a tangent there, but I thought it was kind of related to this inequality.
Oh, definitely.
I think that goes hand in hand with my theory.
There's a famous quote, you might know it, that says, if more people understood the financial system, there'd be a revolution in the morning, something like that.
Yeah. I think Henry Ford said that.
Okay, yeah, cool. This is where I do want to now get into I've coined it. There you go. There's a good dad joke for everyone at home. The digital Thickshake theory, and this builds on your US dollar milkshake theory. So how this works is that at the moment the swap lines, as you say, the Federal Reserve giving Australia a direct pipeline with more US dollars, so they don't have to suck US dollars through the straw out of the US, competing with everyone else. So that is what they're trying to do with help the liquidity when everyone in Australia is trying to get US dollars the other day, for example. What I think is now happening is that the stablecoin world maybe do you want to give us your understanding of stablecoins first, and then I'll build on my theory.
Actually, I'm probably not the right guy to give you the understanding of stablecoins, but as I understand it, it's basically a digital form that's actually fully backed by the underlying currency. So if you chose to cash it out, or if you chose to take physical delivery of the underlying, you could do so. I don't know if I'm explaining that correctly, but
I was just asking what your actual understanding is personally, so I can explain the whole theory to you. Yeah, cool. And there are going to be people at home, our audience, that are familiar with it, but hopefully this interview gets a lot of traction and there's people that don't know about stablecoins. So as you say, they're just pegged to a other currency, and most of them are US dollar stablecoins. So you've probably heard of Tether or USDC. Now they are in a digital form, so you can put them in your digital wallet or on your Coinbase account, send them to another exchange, or send them to your phone crypto wallet app, or store them on your home computer or your hardware device. So you can actually become your own bank once you have these digital dollars. Now, you've still got your trust to some degree in the company that is running this system or pegging that dollar. And that's when we have a step further, and this is a little bit more complicated, but we have decentralized models of this, where they're backed by other things like Ethereum, or they're adding Bitcoin now, so that you're not reliant on a bank and a company in America to do the pegging for you. But what happens now, and we've seen those markets explode from around $1 billion to $10 billion in the past 12 months, because there is just such a huge demand around the world. We're talking trillions of dollars demand for this US dollar, and now people can get them in a digital form. There's billions of dollars of demand, but I think that can still 10 or 100x. And recently I changed my I really do think that stablecoin market cap could surpass Bitcoin or Ethereum. Now, eventually I think that Bitcoin will capture all that market cap, because what's happening, doesn't matter if it's a digital form, it's still dollars that are getting printed. They're pegged to the thing that's being devalued. And once people put two and two together, that, things that are more scarce, like gold and silver and Bitcoin that you can't print, that is the better store of value. So that's where it all goes eventually. But for the time being, the fact that I can download a crypto wallet, or Brent can open a Coinbase account, or even without that step of signing up, I can just tell him an app to download on his phone, and I can send him US dollars. And that doesn't matter if he's in Africa, Antarctica, or the US. We can now get digital US dollars to people within 30 seconds, and it costs a cent on Ethereum to do all this. So that's kind of where I think that the system you're describing is now a thick shake. It's very, very hard, if not impossible, for everyone to suck through that straw compared to what is happening in the digital world, where anyone can open up swap lines or a direct line to trade and do commerce digitally with US dollars. So, are there any thoughts on that when you're hearing all that, or?
Yeah, I think, and this is something I haven't kept as much up to date as I probably should. But I guess the question would be the bandwidth of being able to send back and forth, and the confirmation of the transactions, so that it's provable, and whatever the right proof of state, or whatever the right terminology is.
Yeah.
As I understand it, it's not quite as fast as many people say it is. Maybe you'll disagree with me on that. But I do think, I think that this is going to continue to happen. People are going to continue to look for ways to circumvent the system, right? And not only that, but one of the big advantages that the U.S. has, and part of the whole milkshake theory, is the U.S. dollar payment system. When money gets wired from Turkey to Australia, it typically is done in dollars, and it goes through a U.S. bank.
Yes.
The U.S. corresponding bank.
Yes.
And the U.S. controls those channels, those tubes, the wires, that the straw that flows through is controlled by the United States. And so as people look to circumvent that tube or that straw, these things like what you're talking about, I think will fill that void.
Yeah.
I think the question I have, and again, I'm not as up to date on this as I'm sure you are. I am of the opinion that while governments cannot necessarily shut these currencies or these digital coins down, that they can have a lot more influence over them than many people think.
Yes.
And whether it's through laws or legal tender, applications or regulations, and I think as long as it doesn't threaten the U.S. channels and take it as a threat to the actual U.S. dollar system, then and it actually perhaps enforces the U.S. dollar as the medium of exchange, they may just let it go. But if it starts to threaten it, then I think that they would do something to try to limit its action. But I think to the one of the things and I think this is what you're getting at, it can actually increase demand for U.S. dollars as opposed to decrease demand for U.S. dollars.
100%.
And I tend to agree with you on that.
I mean, we see it firsthand. We have got thousands of traders or investors that follow us in the comments, and when the markets start to tumble and those hundreds of messages start rolling in, how do I get into dollars? Well, the easiest way is for these people that have their crypto app to just click that button and go into a digital form of US dollars. And that's never been possible in the last GFC.
So move from one of the digital coins to a stable coin, a US dollar stable coin.
Or a lot of these exchanges let you sit in US dollars. So it doesn't really matter. But compared to the GFC, there's thousands, tens of thousands, hundreds of thousands of investors that now see US dollar as a safe place to sit. And I think that's what's happening. Just to talk about your concerns a little bit. So at the moment, a lot of this is happening on Ethereum. Compared to Bitcoin. So you hear about how Bitcoin's slow, 4-7 transactions per second. Ethereum's not a lot better at the moment, say 10 or 15. But we are implementing a lot of these scaling solutions already on mainnet. So there are ways for me to send it to you right now, thousands of transactions per second. So the bandwidth has dramatically increased, and it's not even, the size doesn't matter. So I can send you $1 or $1 million, and that still costs a cent. So I think a lot of these problems have already been solved now with these apps, and it's just a matter of educating people on how this works and getting them to use it, because the system is so much better, and that's where the Thickshake theory. It is just so much better the way that it's all flowing around the world compared to the US dollar system. Now, as you say, I do agree they're going to come down on this if it gets too good, but at the end of the day, all they can do is fight the on-ramps and off-ramps. But if Coinbase come out and say, well, we've done everything that you've asked us to, the regulation, we've got the banking license, we've met all your demands, do you lobby that? Do you fight that? And even if they close all that down, then we go to that next system that I spoke about, the decentralized model, where there's no company. And in the Libra, the Facebook Congress hearings, when they say, well, we can't issue the Bitcoin CEO a demand letter and get him in here because there's no CEO of Bitcoin. It's the same thing. These are just software apps that you can't stop. There's no one to bring in. So that's the way that I think about it. And I think that this is the most interesting thing happening in global finance.
Well, I will say that regardless of how it happens, I think digital coins are here to stay. And whether they end up being independently decentralized market-based digital coins or government-sponsored digital coins, this is coming.
Yeah.
I'm not going to get this exactly right, but I think like the chief counsel or somebody in the legal department, high up in the legal department of Coinbase, recently went to the U.S. Treasury.
Yeah.
So it's not like the U.S. Treasury isn't thinking about this. And I know that back in, I think it was January, was it January? I think it was January. The Treasury met with Facebook regarding the Libra project. And I believe, if I have this right, the outcome of that was that there's some kind of I don't know, I wouldn't say cooperation, that might be too strong of a word, but there's some kind of a collaboration, with Libra becoming a US dollar.
That's right. They pivoted.
Coin.
They pivoted from the basket idea to individual currencies.
Yeah, exactly. So listen, the central banks, this is no longer a secret. The central banks know, the treasuries know. And if you think about MMT, there's no better way to spend money into existence than through a digital coin that can get distributed. And you can distribute it in 10 seconds or whatever it is, 10 minutes. All of a sudden, everybody's got $1,000 in their bank account. And then they can say, you know what, we programmed this, so it expires in a month. You need to go spend it. So it gets into the economy. Do you know what I mean? So they can track it, they can tax it. They can, it escapes the bank reserves. So, it doesn't just go there and sit inert. It's actually in the real economy. Velocity of money picks up.
Yeah.
So it's too powerful to go away. I don't know the state in which it's going to exist, but it's not going away.
No. And that's why I love picking your brain and Raul's and talking about this bleeding edge stuff that I see happening, because it's so relevant to everything you guys are saying. And I don't want to talk about so much the privacy concerns, because we know that's why these things are coming, particularly from, say, China, because they want to monitor everything people are doing. But also, as you say, they can get people to spend it, or they can put a negative interest rate on it, or they can say it expires. They can monitor everything that you're doing. But one of the other concerns that we've heard recently is they don't know how much cash is in the shadow system. And I think this is a bigger problem in Australia than the US. So they don't actually know how many digital dollars are under the mattress. And when velocity of money picks up, they don't know if there's $10 trillion of cash that's going to go get spent in the economy, or $1 trillion. Whereas if that's digitally, they know exactly how many are out there and are starting to move.
No, it's a fascinating topic. It's kind of like the last remaining wild west market. There's the law's coming, but the law doesn't completely exist yet, right? The few sheriffs are starting to show up, but it's still kind of a not lawless, that's not the right way to say it, but it's still kind of a wide open frontier where the decisions are still being made, so to speak.
Trust me, it's still the Wild West most of the time. The other thing, just to touch on quickly, was the DeFi, decentralized finance, which this is part of already, but we're seeing a lot of yield. So in this space, you can lend out your coins to traders or these startups that need more liquidity, and you can get quite a high interest rate, say 8% a year. Fluctuates a little bit, but that's just far greater than what we're getting in any central bank. And if Bank of England goes negative, then the US might have to Australia. I think that's another thing that's going to bring in a lot of capital. You can either get minus 1% or 8% if you download this app. I just think that is a no-brainer.
Yeah, absolutely. It's fascinating.
Cool. Finally, I guess people want to know, well, what's the actionable outcomes here? We can't give financial advice, obviously, but what we've described, I guess, is the inflationary scenario or the money printing scenario where money is going to go into things that are scarce. And funnily enough, that might be an Apple share that's more scarce, speculating. So yes, gold, silver, Bitcoin, that's what people are thinking of. That's where the money goes, I guess, the step after everyone's seeking the US dollars to pay down their debt or safe haven. Do you think that that's the way things go, or is it deflationary with assets going down?
I mean, like I said, I manage client portfolios and I manage a client fund, and the presiding theme through all of those different options are that we think the dollar is going to get much stronger. So we have positioned ourselves to be long the things denominated in dollars, I should say US dollar assets, because we think they have the highest likelihood of appreciation, and we're short just about everything else. So we're short a number of commodities, we're short a number of countries, we're short a number of currencies. I mean, we think the Australian dollar is going to get a lot weaker over the next couple of years. We think the Brazilian real is going to continue to fall. We think the euro will continue to fall. We think the Hong Kong dollar peg will break. We think this is a currency crisis that will morph into a kind of the global asset price crisis. So we think the presiding force right now is deflation. But the mother of inflation is deflation. It's because it's the response to the deflation which will eventually cause the inflation. I don't think we're there yet. I think that opportunity is coming, and my plan is to have some profits to redeploy in some distressed assets when the inflation comes.
Absolutely. And when you say denominated in US dollars, a question we often get, and people get this wrong, is that just because something like gold is denominated in US dollars, it's all relative again. So you can think about it like gold being a currency, if you like, where if money are going into these things out of everything else, it doesn't mean that gold and the US dollar can't maybe rise in tandem, even priced in US dollars, do you think, going forward?
I think in the very short term, over the next 2 or 3 months, I think gold's kind of at a high here. I don't think we're going to 2,500 on gold next week. We could. And if we do, I own gold, so that'll be fine. But I think that's unlikely. But I think in other currency terms, I think you can just back up the truck on gold. What I would say, we actually have some Australian clients, and they've come to us because they own gold. They live in Australia. They're denominated in Australian dollars. They own gold. They think gold's going to go up in Australian dollar terms. But now they'd also rather be exposed to US dollars because they think versus the Australian dollar, the US dollar is going to go higher. So they've allocated funds to us to where that we can take advantage of the dollar strength. I mean, if you think about it in just very simple terms, if you live in Australia and you buy Coca-Cola, and Coca-Cola pays a 3% dividend, and the Australian dollar falls by 6%, now you've got 9%. And if Coca-Cola happens to go up 5%, you've made 14%.
Absolutely.
It's not a bad trade-off. And I think the likelihood of that happening is better than, buying a Australian bank and putting it in your account.
I couldn't agree more. Some of my friends that are hedge fund managers just say they've got zero exposure to Australia because all their capital is going into America because they see that is the economy that has the greatest opportunity to even grow at 1 or 2% where these other countries are in recession. Yeah.
I mean, that's the milkshake. That you have just described the milkshake in a nutshell.
Awesome. I think that's just about everything I had. Is there anything we haven't touched on today? Maybe some of the counter arguments that people say you're wrong. You have already described them a little bit. But
I think the main thing that I would say is that when people think about fiat currencies, they primarily focus on supply. And with all the supply increasing of fiat currency is going to lose value. Okay, I'm not going to argue that. Of course, that will eventually happen. But you also have to understand that even if the U.S. prints a lot of money, there's an incredible amount of demand for the U.S. dollar. And because all fiat currencies trade relative to each other, when doing your analysis of fiat currencies, you also have to focus on the demand side. And then just ask yourself, is there more demand for Australian dollars or U.S. dollars? Is there more demand for yen or U.S. dollars? Is there more demand for rubles or U.S. dollars? You don't have to do too thorough of analysis to know that the demand for the dollar is higher than every other currency in the world. The question is whether or not the Fed can print fast enough to offset that demand faster than the RBA can print to offset the demand for Australian dollars. My argument is that the demand outstrips the supply. And on a relative basis, the US dollar is going to rise versus other fiat currencies. And I think that's an incredibly powerful piece of information to have as you allocate a portfolio.
Yeah. I actually think that Philip Lowe, in terms of central bankers, is one of the he's too nice, he's too defensive. He didn't want to cut rates, and they were one of the last two. He said he doesn't want to go negative. They started QE, and they were very quick to taper. So I think that's maybe one of the arguments that could keep the Aussie dollar a bit stronger relative to everything else, because he's going to have to cave and just do money print to go brr like everyone else, and he doesn't really want to do that.
Yeah.
And I think the biggest takeaway for people at home today was to understand, as you say, that money printing doesn't necessarily mean inflation, because a lot of the time it is just going either to filling up those buckets or those Ponzi schemes, you can think of it as everyone's trying to get out of these falsely inflated valuations, and everyone else is trying to get dollars out of there back to their own country. So there's so many reasons why that's not going to cause inflation. And we know that is to the tune of tens of trillions of dollars, the demand that needs to be met.
Yeah, exactly.
Awesome.
Exactly.
Well, I think that's everything, Brent.
Thank you for having me. I've really enjoyed it and happy to come back and talk to you anytime.
Absolutely. Yeah, it was absolutely amazing. I hope you guys have really enjoyed that. I'll put the links to follow Brent down below. Any final words for people, Brent?
No, I look forward to coming back to Australia in a few years and maybe buying some assets at a decent price.
Awesome. Thanks for joining us today, mate. Thanks, guys.
All right. Thanks.